What is a hedge fund? A hedge fund is a type of investment fund where wealthy individuals or institutions pool their money together. The goal? To try and make high returns, often by using more complex strategies than you'd find in a typical investing platform. The word hedge originally meant to protect against financial risk, like putting up a safety net. Some hedge funds still try to do that, but many today take on high risk in search of even higher rewards. Unlike a regular fund that might just buy shares or bonds, a hedge fund can do all sorts. Buying and selling quickly, betting on prices going down, or using borrowed money to boost profits. It's like a financial toolbox with extra tools. Why does it matter? Hedge funds play a big role behind the scenes in financial markets. They can move a lot of money, influence prices, and spot opportunities before others do. Sometimes they even help protect pensions and university endowments by aiming for returns when other investments aren't doing well. You might have even heard about them in the news, like during the GameStop saga in 2021, when several hedge funds lost billions because they bet a stock would fall and instead it soared. For investors with deep pockets, hedge funds offer the chance of high rewards, but they also come with high risks. For everyday people, it's more about understanding how these funds can affect the wider economy, from market swings to company share prices. They're also deeply connected with banks, asset managers, and governments, making them a powerful, though sometimes unpredictable, part of the financial system. Here's a simple example. Imagine you have £1 million, we're dreaming big here, and you give it to a hedge fund manager. They don't just buy 10 companies and wait. Instead, they might buy shares in Company A because they think it'll do well, and at the same time sell short Company B because they believe it'll drop in value. If Company A goes up and Company B goes down, the fund can make money both ways. They might also borrow another £1 million to invest even more, hoping to double their gains, but also doubling the risk. This is called leverage, and while it can boost profits, it can also amplify losses. It's more active and more aggressive than most traditional investing. What else should you know? Hedge funds aren't open to everyone. Because they're risky and lightly regulated, they usually only accept accredited investors, wealthy individuals, or large institutions who can afford to lose money. In the UK, that often means having an income over £100,000 or investments worth more than £250,000. You generally won't find hedge funds on everyday investing platforms or apps. They can also be quite secretive about what they're doing, which makes them harder to understand or track. Not all hedge funds succeed, and some lose large amounts very quickly. They also charge high fees, often a 2 and 20 model. That means 2% of your money goes to management fees every year, and 20% of any profits goes to the manager. So even if you do well, the fund takes a big slice. If you're just starting out with investing, hedge funds aren't where you begin. Simpler options like index funds or diversified portfolios are much better suited to beginners. To sum it all up, hedge funds are private investment funds that aim for big returns using complex and flexible strategies. They're mostly for wealthy investors, carry high risk and charge high fees, but they also play a major role in global markets. While they're not designed for everyday investors, understanding how they work can help you make more sense of financial news and market movements. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.